Now friends, let me clarify with respect to the time and value of supply. Friends, the time of supply, that what is a very simple topic of discussion. For example, that you are supplying some goods or services. What is the time of supply? Now, for example, the question is like, in which month you will have to pay the GST. Now, for example, a borderline transaction, for example, you have sent the goods on 28th of a particular month, then invoiced on 29th of a month, and maybe the payment is received on 2nd or 3rd of the next month, or you can interchange the dates. So, for example, the borderline transactions, that means whether your GST obligations, whether your GST liabilities, whether it will be in relation to the first mentioned month, or it will be in relation to the next month, or this quarter or the next quarter, whatever as the case may be. So in order to identify that what is the exact time on which that you have already supplied the goods or the services, that is also always a crucial factor, okay, in a typical situation. So for that, we have a special set of provisions. So first of all, friends, let me explain to you what is a time of supply. The time of supply is in fact a very simple thing, and in the macroeconomics, in the macro understanding of this particular time of supply, it is by default generally whether it is a invoice date or whether it is a payment date. I repeat, whether it is a invoice date, that means whether it is a documentary date, or whether it is a payment date, whichever is earlier. So in majority of the places, friends, the concept is invoice date or the payment date. Now, when it comes to the invoice date, now people can always manipulate this. Now, imagine from the lawmaker point of view. That means if I have to issue the invoice, I am a taxpayer. So what I will do is I will delay the issuing of invoice. No. So moment I delay the invoice, I may do all the transaction, but I will not issue the invoice. So ultimately by not doing that, I will delay the payment to the government. So that will create a problem. So when should the invoices be issued, or what is a correct date? What is a correct date of the issue of invoices? Another small little chapter. That means in a typical situation, when should the invoice be issued? Because then people should not be given a free hand to issue the invoice whenever they want. I mean, that cannot be the situation. So that be the reason there is one integrated chapter which will explain to us that what is the correct date when the invoices should be issued. The same thing for the payment also. When it comes to the payment, there is always something called a book entry or a bank entry. That means the in the bank account you might have received the payment, but you will delay the passing entry in the books of accounts, so that ultimately you will like to delay some sort of a payment. So there also law makes it very clear. In general, I am just telling you, book entry or a bank entry, whichever is earlier. So general test to understand that there is a correct method which is prescribed by the law for the issue of invoice, and there is a correct recommendation that book entry or the bank entry, whichever is earlier. So logically you will say that this or this date, whichever is earlier, so whichever is earlier date will be relevant for the purpose of your payment of GST. That means in order to meet your GST obligations. Now further, these provisions of section 12 and section 13, further they are divided into for the goods and they are divided into for the services. For the services, there is a little bit of a different concept, and for the goods, there is a little bit of a different concept. And for the goods on the forward charge, there is a different concept, reverse charge is a different concept. Same thing for the services. Forward charge, different concept, reverse charge, different concept. But in most of the places, there is an integration. Integration is basically the invoice date or the payment date. This is how broadly it is to be understood. That means in an examination condition, supposing if you just miss out on that particular, oh my God, you get confused or something like that. So you have to think like that. The documentation date, that means the invoice date, or maybe the payment date, whichever is earlier. And if you follow this particular theme, mostly I'm telling you 70 to 80% of the situation you will end up with the right answer. However, for the reverse charge, because reverse charge is basically now your purchase transaction or whether it is your cost transaction, for that it has been said that it is after after a particular date, that means on a particular date, that is particular is to be considered. That means after certain days from the issue of invoices or the payment date, whichever is earlier, or the receipt of goods. Okay, so here you have you are going to receive the goods, so actual receive date, document date, and the payment date, whichever is earlier, as the case may be. The similar situation is there with respect to the services also, but services, the number of days is something different, so that you have to consider. And all these things is the MCQ material for the purpose of questions in this particular chapter. Now in relation to the services, this point can really be confusing to the student, and in my regular class I have already put lot of emphasis on this particular concept. Supposing in relation to the services, I do not issue the invoices. See, normally the invoices is to be issued as per the correct procedures, but supposing if I do not issue the invoices, so supposing there is a service and I have to issue the invoices. If it is correctly issued, then invoice date or the payment date, whichever is earlier. However, if the invoice is not issued correctly, in that particular situation, it is the provision of the services that is very much relevant. So when did you actually supply the services, okay, or the payment date? So everywhere the payment date is always to be compared, whichever is earlier. Now, but the logic of this particular provision is also further very clear, that supposing when I say payment date, invoice date, whichever is earlier, so if the payment is received earlier, that means logically if it is advance payment received, it will also become a supply. So in other words, it is a payment date or the invoice date, whichever is earlier, and logically, friends, I'm just telling you, if the payment is received in advance, it will also be treated as your supply. Basically, it will be chargeable to the GST. Even the advance payments will be chargeable to the GST, as the case may be. Further, if there is a transaction is only one, you have taken an advance payment separately and the full and final payment separately. So you have to consider advance payment as a separate transaction and full and payment as a separate transaction. In other words, one particular transaction you will have 2 dates of supply. I repeat, one particular transaction you will have 2 dates of supply. One is to the extent of the payment, and second is when that invoice etc. has already been finalized. And this is also very crystal clear, which is provided under the GST provisions. I will show you that particular provisions also in just some time to go. On top of that, there is some rounding of provisions, rounding of situations like provision where there is advance payment which is but less than some very 1,000 rupees or something like that. It will also be not regarded as kind of a supply. That also things which I will just bring it to your notice first of all. Now, one thing which I want to clarify is, as I already explained to you, invoice and payment, whichever is earlier. Look at these particular explanations. Okay, this particular explanation, the supply shall be deemed to have been made to the extent it is covered by the invoice or as the case may be by the payment. And this is what I just tried to tell you, that if there is a part payment, then there can be a supply to the extent of the part payment. So you can have 2 separate dates for one particular transaction only, to the extent of the payment and to the extent of the full and final settlement is a possibility. Further, the payment book entry or bank entry, whichever is earlier, so credited in the bank account or it has been entered into the books of accounts, whichever is earlier. This is basically the standard theme. I mean, everywhere section 12 and 13, this is a standard theme which has been followed by the provisions of this particular law. Further, this particular provision, which is with respect to that, as I told you, the rounding of difference. Now, say for example, your bill was, your bill was 26,870 rupees. Okay, but now you have received the payment, say for example, round figure 27,000 rupees. So this is how it sometimes happens, no? So that my bill was this, but the marginal difference. So when that person had to pay the money, he didn't remember the amount and he gave me the rounded off kind of a payment. So now what will happen is, the balance difference will be something like an advance in my books of accounts. So in my books of accounts, I have to receive only 26,870. Now the top 130 rupees will be just like, I mean, appearing in the books of accounts, because to that extent I have received the advance payment, and logically, friends, I am going to adjust that particular money against my next billing. So this kind of marginal differences will not be treated as supply. This is what it is just trying to say, that amount up to rupees 1,000, which is in excess of the amount indicated in the tax invoices, okay, it will not be treated as a supply, or rather the law actually says that at the option of the supplier, the date of the issue of the invoices in respect of the excess amount. That means at your option, if you want, you can take it as adjustment towards your next invoices, and to that extent you are having a liberty, the more small marginal difference, but the institute can really catch you on this particular front in the examination point of view, and that is the reason I brought to your notice. Now in relation to the forward charge, okay, in relation to the forward charge, I already told you that it is on X particular date. Okay, so it says that receipt of goods, this is your forward charge. Reverse charge. This is in respect of your reverse charge, the receipt of goods, the date of the payment as entered, the date immediately following. And here also this is a very good MCQ material, that this is the date immediately following, the date which is immediately following 31st day. All these dates is like, whichever is earlier. So don't forget that the standard theme of this particular section, that the time is whichever is earliest. Okay, so date immediately following is 30th day, and that's the reason in our tabular presentation we make it as 31st day. Just look at this. This is what I have made it as 31st day, because it is a date immediately following. So In MCQ, no, that's the reason I brought it. In MCQ, you have to say the date immediately following. That way, if they give you the choice, okay. So, I just bring it to your notice. Similar situation for the reverse charge of the services is 61st day. Okay, that is how it is to be understood. In relation to the services, friends, as I told you, this point is very important. I want to bring it to your notice that in case if the invoice is not issued within the time, okay. So section 13, 1 second, friends. Section 13 and reverse charge. Okay, so section 13 paid on the reverse charge basis. Okay, now this particular point immediately following 60th day. This is one of the points which I wanted to bring it to your notice. And another point which I wanted to bring it to your notice was that star point, that where it will be the provision of services. This was the main point. The provision of services will be the relevant date in case if the invoice is not issued within the prescribed time. So particularly for the service people, the law is a bit more stricter that your invoices should be within the time. That means if your invoices are not within the time, then your date of providing the services will be the most relevant date, and accordingly that particular period, that means that particular month or the quarter, as the case may be, you have to do your GST obligations where you are not issuing the invoices. However, if your invoice is already issued which is correctly within the prescribed period under section 31. Section 31 is basically another concept which tells you that how the invoices should be issued properly within that particular time frame or the date of the receipt of the payment, whichever is earlier. Okay, so these two difference in relation to the services should be kept very much in your back memory, because here I feel that not only the MCQ material but also the real detailed questions is very much possible in this particular scenario. Okay, further, in case if there is any such transactions which are carried out in relation to the goods or services with respect to the vouchers, okay, so if any transactions which are done with respect to the vouchers, goods or services, okay, if the supply is identifiable, that means, for example, if there is certain vouchers which are for a specific supply, that means you can use that particular voucher only to buy a particular goods. Or say, for example, there is a voucher which is given to you, which is only to be used for the purchase of, say, for example, shoes. Okay, so now it is already identified. In that case, the date will be the date of the issue of the voucher. But if it is not identifiable, for example, you get a voucher to do shopping into the say for example, food bazaar, or say for example into the mall. So in a mall, you can go anywhere and do that particular shopping or something like that. You get Amazon vouchers, for example, in the Amazon voucher, now whatever is available in the Amazon, you can buy it. Okay, so if the goods are not identified with respect to that particular voucher, in that case the date of redemption of the voucher will be relevant. Similar concept applicable in relation to the services also, date of the voucher or the date of the redemption of the voucher where any such supply has been effected through or via voucher transactions, because this is also a very, very popular kind of a transaction in the real life situation. The next good thing which is to be kept in mind under this particular provision is section 31. What is the correct date of issue of invoices? Because everywhere invoice date is the relevant date. Now, one of the things which I want to bring it to your notice, that there is a concept of a correct date. What do you mean by a correct date? That also you better understand. Say, for example, if you do not issue invoice, if there is no issue of invoice, then section 31 will tell you that, okay, this is the date which will be considered as relevant. You have not issued the invoice. So this is a upper time limit by which the invoice should be issued. You haven't issued it, forget it, that's your problem. Section 31 will say that your date of invoice will be deemed to be this particular date. In other words, this section 31 is a solution to those situations who do not issue invoice. That is one situation. Second situation, somebody who issues invoice but they issue late invoice. So even if you do a late invoice, then also section 31 will catch you. Then section 31 will say that this is the maximum upper time by which the invoice should have been issued. You have not issued, forget it. This upper time limit is your deemed date, and accordingly the GST obligations are to be complied with. And if you haven't done the GST obligations, then GST law will say there could be some penalty, interest, etc. kind of situations which can keep coming in the scenario. Okay, so this section 31 is further divided into two parts. That is, one is for the goods, other is for the services. Okay, now most of the transactions with respect to the goods, that what is the upper time limit by which the invoice should have been issued. If you have not issued, then that will be the date, which will be the proper date, will be accounted for the purpose of GST, and accordingly you will have GST obligations to be done. Now, if there is any movement of goods before the removal of the goods, a very logical date. For example, if you are removing goods from the factory, so before the removal, you should have issued that particular invoice. If you have not issued the invoice, then the date of the removal will be regarded as the relevant date. Okay, where there is no movement of goods before the delivery. So before delivery, you should have issued the invoice. In other words, the delivery date will be the relevant date. That we understand. Goods on approval basis within 6 months. So if you are sending goods on approval, so within 6 months of the sending of goods, you have to issue it. If you're not issuing it, then at the end of the 6 months, straight away it will be regarded as your relevant date for this particular purpose. In relation to the continuous supply, before issuing the accounting statement, this is one of the very, very important point. And in my regular class, friends, I have done quite a good number of questions on this particular front. You better revise them all very clearly. So in case of a continuous supply, or say for example, there is a situation where there is no bill to bill supply, say for example, or bill to bill payments. So you keep on issuing bills over a period, then you issue a statement and the money keeps rolling in. Okay, so you will never probably know that exactly which payment is for which particular bill. All these situations will come into picture here. So before issuing the accounting statements, that means, say for example, you are giving a quarterly statement to your customer saying that, okay, this is your quarterly payment which has already fallen due. So in that case, before the date of issue of invoices, before the date of issue of accounts ledger, you should have issued the invoices. And logical, this is a very logical law, because your account statements, you will be doing debit credits. How can you debit credit the transaction without the issue of invoice? In other words, your accounting entry by itself has to be on a particular date, and that particular date will be considered as a relevant date normally. But still you are saying that, oh, I'm confused or something like that, then the law says, then your upper time limit for the issue of invoice, I repeat, the upper time limit for the issue of invoice is the issue of accounting statement. That means that is a deadline. And if you have still not issued the invoice till the issue of accounting statement, then the date of issue of accounting statement is the relevant date, will be considered as the date of issue of invoices. Okay. In relation to the services, within the 30 days of providing of services, that you should issue that particular invoice. So that's a upper time limit which has already been provided. For banking, it is a 45 days which is already provided. For continuous supply, here exactly similar kind of modus operandi, but little bit of a different concept is where the due dates are available for the purpose of payment, then such due dates should be understood, or before the payment or before the completion of the event. In other words, wherever there is a continuous supply, basically there's a different test which has been provided. So whichever test that comes earlier, that particular test is the relevant date for the purpose of issue of invoices under this particular services. So this section 31 is basically going to guide you, and in detail, friends, I already discussed a lot of questions I have solved on this particular front. Just take a little bit of time, just turn those particular pages, solve and just go through that. Right now there is no point in solving the questions, but just go through those particular questions which highlights all these concepts, the correct date of issue of invoices, and the time of the supply of goods or services, as the case may be. Now friends, let me take up some particular discussion with respect to the time of supply. Okay. First of all, friends, this was one of the old notification, but it has been withdrawn. So first of all, this is completely withdrawn, but I just bring it to your notice that this was a notification which basically stated that the advance payment with respect to the supply of goods subjected to the conditions will not be regarded as a supply. However, friends, this particular concept that the advance payment will not be regarded as a supply, this particular concept, of course, this notification has been withdrawn. Okay. However, instead of that, now they have already brought a new notification. In fact, this is a more friendly notification. That's the only reason I said this particular notification is just the extension of the previous notification. This is a more friendly notification. But here you have to understand the basic thing very carefully, that first of all, this particular notification is applicable. See, the government notifies that the registered person who did not opt for the composition levy under this particular act, that is under section 10, okay, and a class of persons who will pay the CGST
only on, of course, this is for CGST, so CGST as GST, okay, on the outward supply of goods, okay, at the time of supply. Okay, so you will make regard it as a supply. You will make it regarded as a supply only if it is for the outward supply of goods. So this particular benefit is with respect to the supply of goods. So you will be subjected to the tax only at the time of making the supply. That means, supposing if 1 lakh is advance payment and the 9 lakhs you are receiving afterwards, and the total value, say for example 10 lakhs. So the time when you have received this particular 1 lakh rupees, at that time the advance payment with respect to the goods will not be regarded as a supply. But when you are actually supplying, supposing 10 lakhs, at that time the entire 10 lakhs will be regarded as a supply. So basically, when I say that it will not be regarded as a supply at the time of advance, that doesn't mean that it is not a supply. That means advance payment per se will not be regarded as a supply, but when there is an actual supply, it will be regarded as a supply. So when you go into this particular point, it says that first of all, it is only for goods. That means if it is any advance payment received with respect to the supply of services, it will be regarded as a supply. So on merits, okay. So this concession have been given only with respect to the transaction of the goods. Further, it is applicable for those people who did not opt for the composition supply. Okay, so for the composition dealers, this particular benefit is again not applicable. Secondly, friends, this particular provision will be applicable only when there is a supply which is referred to under section 12 subclause 2 subclause A. Okay, only for these type of transaction it will be regarded as beneficial point from this particular notification point of view. In fact, under section 12, friends, there are some other types of transactions also. So this notification that advance payment will not be regarded as a supply, this particular notification is applicable only for those transactions which are covered by section 12 subclause 2 subclause A. Okay, and other clauses, this notification will not apply. So in a sum and substance, friends, I've just made this particular small little analysis for you, saying that, see, if it is a service, okay, then advance payment can be regarded as a supply. But if it is for the goods, then it will not be regarded as a supply, but only that transaction which is covered by 12(2)(a). If there is any other transaction other than 12(2)(a), listen very carefully. For example, reverse charge is also one of the transaction of section 12(2) only. But that B, C, D, etc., the provisions are there, those provisions will come into picture. So for them, the advance payments could be regarded as a supply. Okay, so in other words, if there is an example also, say already says, for example, a vouchers related transactions. So if there is any such related transaction which is other than 12(2)(a) transaction, then such advance payment can be regarded as a supply. In other words, the benefit is extended only to 12(2)(a) transactions. Okay, for all other transactions, normal provisions will be applicable with respect to the advance payments which have been received by the taxpayer. Now, friends, there is one more clarification from the circular which I want to again bring it to your notice, and that is, just imagine a particular transaction that, supposing if there is an export of goods for the purpose of exhibition or for the purpose of display outside India. Now, just imagine a transaction that I am a person inside India. I'm sending some goods outside India, but I'm not exporting the goods. That means I'm not selling it to that foreign person, but I'm sending my goods for the purpose of some exhibition or for the purpose of some display outside India. Okay, and so that I can boost my sales and promote my sales. Basically, it's a promotional scheme, but I am not selling my goods to someone outside India. So in that particular case, the circular has clarified that it is not a supply. The reason being that it is not for a consideration. In other words, only sending goods outside India by itself does not amount to a supply. So very, very simple thing which has already been clarified. Okay. However, now the further extended question is that goods have already gone outside India. Okay. And up to a specified number of period or days or months, the goods are not. See, supposing if I'm not selling the goods outside India, then the goods should come back to India also. No. See, for example, if I send the goods abroad for only for display purpose, for example, then after the work is over, it should come back to India. That's a very logical thing. But if it doesn't come back to India, now the extra clarifications come. If it doesn't come back to India within a period of 6 months, then the invoice has to be issued and it can be regarded as a supply. Reason being that from the removal, that's basically the time of supply, the basic concept. From the date of removal, within 6 months, you should issue the invoice. So either it should come back, or if it doesn't come back, you have to issue invoice, and accordingly it can be regarded as a supply. So that particular 6 months time, which is a default time limit from the date of the removal, that will continue to operate. So supposing within 6 months if it comes back to India, then there is no problems. That means everything is neutralized. But if it doesn't come back to India within a period of 6 months from the date of the removal, then it will be regarded as a supply, and you have to do appropriate documentation. That means you have to issue appropriate notice, because you are crossing the limit of 6 months. Now another probability, supposing within the 6 months some quantity you sold and some quantity you brought back. Okay, so for example, you have exported 100 quantity and 20 quantity you have already sold. So you have sent the goods outside India but not sold the goods. But when the goods were in the display, you got some customer outside India and he purchased it, but you sell only 20 quantity. You are not selling full quantity. So then it is very simple. Whatever quantity you have sold, you issue the invoice. Okay, so regard it as a sale. If it is export, take it as an export and do other formal. Then when export is there, then zero return benefit, etc. also can be taken. So it's not that it cannot be taken. But however, whatever is sold, to that extent you have to issue the invoice. What will happen to the balance quantity? Same thing, wait for 6 months. So within 6 months it's come back, it's okay. Otherwise issue the invoice. Simple as that. Okay, so when partly goods have been sold within the specified time, then to that extent you should issue the invoice. It will be treated as a supply. Finish. Okay, now in this particular case, further clarification is that when the goods are being sent outside India for display purpose, exhibition purpose, you have to maintain the necessary records basically. Okay, so there is some register type situation which is recommended in this particular circular itself. Okay, so this circular is told that these many columns and all that basic data and all that you have to maintain. So the prescribed records have to be maintained. It's a very natural thing that until the entire, either it is sold or it has been brought back, I mean, you have to maintain the necessary records, and that particular records in the prescribed format which is given to you in the circular itself has to be maintained.
Another point which I want to bring it to your notice, that is, what if there is a change in rates of taxes? This is what section 14 has clarified. Very simple section, but here also good question can come in the examination condition. So just imagine a situation, friends, where you have done a particular transaction and you are in such a borderline situation where now the government is notified that with effect from a particular date, the rate of GST is changing, and you have done that particular transaction just near to that particular date, and in that particular situation you will have that double mind whether the old rate of GST will be applicable to me or the new rate of GST will be applicable to me. So when you have this particular double mind, in that particular situation, section 14 comes into your help, and section 14 says that look at the date of supply, look at the date of invoice, look at the date of payment. Okay, I repeat, look at the date of supply, look at the date of invoice, look at the date of payment. There are 3 events. If 2 out of the 3 events is before the notified date, in that case you will get the old rate, or if 2 out of the 3 events is after the notified date, then you will get a new rate. So that is as simple provisions as that. So you have 3 events. Check out this particular event. 2 out of 3. If it is before, then old rate, that is before the notification rate. And if it is 2 out of 3 events, it is after the notification date. In that particular case, it will be the new rate of GST that will be applicable. The value of supply. Friends, this particular section, the value of supply, is also then supported with the variety of the rules in a typical situation. But right now, I'm just discussing the value of supply to you. Okay. This particular value of supply is a very logical and the straightforward provision. Rather, it basically tells you that when you are arriving at the value of supply, that means logically the transaction value of that particular supply, in that particular situation, certain amounts should be included or certain amounts should not be included. In other words, there is almost each and every adjustment is in fact the logical adjustments, but this is one format type computation that you should better remember, and these adjustments institute can keep on asking you in the examination condition by twisting here and there, ultimately asking you the calculate the value which is subjected to the GST. So this is what is the value of supply. This is what the question that can always come and keep coming in the examination condition. The value of supply of goods or the supply of services or both shall be the transaction value. So first of all, there is a concept of a transaction value, and the transaction value is basically the actual value at which the buyer buy and the seller sell. So it is basically the fair value at which the transaction, rather fair value is also not a correct word, but it is the actual value at which the buyer buy and the seller sell. This particular value is going to be regarded as a transaction value for the purpose of GST. This particular transaction value shall include all the taxes, duties, etc. But other than your GST, that is, for example, your municipal tax and this tax and other taxes, they will be included in for the purpose of valuation. Further, any amount of which a supplier is liable to pay in relation to that particular supply, but it has been incurred by the recipient of supply and it is not included in the price payable. So it is basically, see, what is the transaction value? It is basically the seller's selling price. So the seller's selling price, whatever is the seller's cost, logically should have been included in the seller's selling price. But if it is not included in that particular price, which is actually incurred by the buyer, that means logically the recipient, but it is not included in the price, you will have to include that particular price. Point number C here is any incidental expense, including commission, packing, charged by the supplier. It is charged by the supplier. That means basically it is a charged by the seller of that particular goods. Okay, which is in respect of the supply or both on or before the delivery of the goods. That means any such charges which are on or before the delivery of the goods, which are charged by the supplier to the recipient, and this particular amount logically, if it is not included, you have to include this particular sum as an incidental expense which is up to that particular place of the dealer, because all these items are to be included. Okay, any interest or the late fees payable for the late payments, this is one of the very valuable thing. Basically, it's a finance transaction, but any interest or the late fees will be subjected to inclusion in the value. Any subsidies will also be included in the value. However, if it is your government subsidies and all that, excluding the subsidies received from the government. So in other words, supposing if you are selling your product for 2 lakh rupees, but you are getting 3 lakh rupees as a subsidy on the another hand, so basically the value of the supply is going to be including subsidy value, as simple as that. Okay, in this particular situation, further it shall not include any discounts. It shall not include any discounts, but here the discount provisions are pretty much in depth, that if the discount is a transparent discount in the sense that if it is indicated in the invoice, this is how it is, and this is duly recorded. Okay, so if it is transparent discount, that means to that extent it will not, logically we call it as a trade discount. This particular trade discount will not be included for the purpose. It's a very natural thing whatsoever, but still the people may still misuse this particular provision, and that's the reason in detail further it says that after the supply, if it is effected, that means if it is before the supply, so it is normally understood as a trade discount, normal understanding. But if it's after the supply, if you are still giving the discount, in that particular situation, it will not be included only if the discount is established in terms of the agreement. That means your agreement has already indicated that this kind of a discount could be given. This is how, that means it will be properly documented. This is what it is just trying to say that. Okay, and this agreement was entered into before the time of the supply. So naturally it was in advance. That means before the supply, only the discount factor was already understood between the parties. Only then the law will say, okay, you parties had understood the discount factor, so we will also understand that. Okay, further, the input tax credit which is attributable to the discount on the basis of the above document has been reversed, or it has already been adjusted accordingly. So naturally, because of the discount, your supply value is also going to decrease. So to that extent, the relevant input tax credit of the other person should also get adjusted. So natural things. So the law makes it very clear that we will do this particular discount adjustment, provided that the appropriate input tax credit adjustments has also been carried out on this particular front. This much adjustment should always be kept in our back memory fully. Any examination question, you should solve it in this particular manner, in this particular fashion. See, whatever is the transaction value which is already been given, do this particular adjustments, add less adjustments, and accordingly, see, the taxes, municipal taxes, etc. is included. However, GST is not included. So it is not including your GST, but it is your other taxes, other than your GST taxes. Okay, any packing charges included, any subsidies included. However, if it would have been from government, then it was not to be included. Discounts are to be excluded. So discounts, but it is subjected to the condition that properly indicated in the invoice or in the agreement, as the case may be, etc. So this is your ultimate transaction value. Logically, you can also call it the assessable value, but by and large, the law says that it is a transaction value. On this, you have to multiply by your GST rates and get the amount of the GST liability, and your GST come value, you will get it. So this is how the adjustments are to be carried out in terms of the value. However, with respect to the value, there is also some other for different industry types, like what will be the value. So there are some different extra clarifications that also I will discuss it. Give me some time, I'll do it as soon as possible. Input tax credit, friends. This is one of the very valuable chapter, and this particular chapter can be, what should I say, integrated with any tax liability calculation. That means any chapter and any tax liability calculation will be subjected to this particular adjustment of the input tax rate. This is a very versatile chapter in the GST regime, and a lot of attention is to be required. And input tax credit is basically tax that you have paid on purchases, for example, or inputs that you have used for the purpose of outputs. So whatever is your inputs, you get the input tax credit in the general way. This particular topic of the discussion, friends, first of all should be divided into following parts. Okay, in certain situations, you have to not get that particular input tax credit. So first of all, there is something called as a block credit. So remember this particular point, there is something called as a block credit. The block credit means in certain transactions or certain type of inputs or certain type of situations, you will not get input tax. This is something like a block credit. That means these credits are just not permissible. So there are some list of transactions that you have to remember. Second thing is, together with that, if you want to be eligible for the purpose of the input tax credit, you have to satisfy some of the basic conditions. And these basic conditions are hardcore basic conditions, like for example, your proper documentation, return filing, your things should be in the order and all that kind of situation. So the hardcore basic conditions that should have been satisfied, and it should not be covered by the block credit situation. So these two things normally works in tandem, normally works together for the purpose of decision making. That first of all, if any client or anybody come to you and ask you whether to get the credit or not, so you check the transactions whether it is in the block list category. That is one thing you check. Second thing you check is whether you have satisfied the conditions to be eligible for the purpose of input tax credit. This is how that you should consider this particular one. So these 2 points are the heart of this particular chapter that we should understand. Then if there is any mixed use of the goods, for example, some of the goods are used for taxable output and exempted outputs also. So if there is a mixed use of goods or maybe even the capital goods, then there is some sort of apportionment. There is some sort of something like a disallowance of the credit or something like that, but some proportionate calculations, etc., which is required to be done. That is your adjustment only when you have a mixed activity. That means your output is taxable also, exempt also, and kind of the situation. Further, there are certain special circumstances with respect to banks and the financial institutions. So there is one special method which has been recommended, because banks, institutions will have a lot of that money transactions, securities transactions, and kind of, so they might have a lot of confusion with respect to the input tax. So for them, there is some sort of a simplified regime which has been recommended under section 17 of the GST, and the very simple one, but that also I will bring it to your notice. Further, it is certain credits into the special circumstances, the very corner part of this particular chapter. Now, for example, if you are a person, okay, so previously you were a taxable person and now you become an exempted person, for example. So there is a migration, there is a what should I say, the change in your attitude to the GST, because your goods previously were taxable and now it is exempted, or let us put it vice versa. So in this particular situations, you will have to adjust your input tax credit accordingly. See, logically the input tax credit is permissible only when your output is taxable. That is one of the hardcore basics. So if your output is exempted, there is no question of you getting the input tax credit or something like that. So you have to match up this kind of a transaction, and there are certain credit adjustments which I call it as special adjustments which need to be carried out, and that is one separate part of this particular chapter. So we will focus first of all on the basic condition, and thereafter the block credits. These two are the main focus of this particular chapter, and thereafter the other points of this particular chapter that I will clarify. Now, first of all, friends, the eligibility criteria, the basic conditions in order you to be eligible for the purpose of input tax credit. Mind well, these particular conditions are pretty important, not only just a good MCQ material, but also it is very important in decision making in a particular question, whether you will be eligible for the input tax credit or not. Okay, so one of the basic conditions that which are provided here. Section 16 is the relevant section. Okay. Now, no registered person shall be entitled to the credit to any input tax in respect of the supply. So, you will not be entitled to the input of the credit unless you have satisfied these conditions. Okay. So, you have to satisfy all these basic conditions, which is A, B, C, D, etc. in order to be eligible for the purpose of getting input tax credit. Now, one of the condition is very simple. You should have the tax invoice. That is a documentary thing. Another good condition is that you should have furnished the return. In other words, if you are not filing the return of the GST only, why should government give you the input tax credit then? So, two of the most documentary important conditions should have the tax invoice, and second thing that your documentation is your return filing and all that everything should be into the order, and only then the input tax credit can be available to you. Okay. Further, you should have received the goods or services or both. That means you should have received. For example, you say you are claiming input taxes. So inputs, though, you should have received it only. No, there is no doubt about that. So the receipt of inputs is something what is very important. However, here the condition is not of using of input. Okay. So in other words, as long as you have received it and it is but for the business purpose, it should be the sufficient criteria. In other words, for example, you have inventories. So on the inventories also, can you use the input tax credit? The answer is yes, you can use that. In other words, exact inventory for the purpose of output, no need to match it. As per accounting and all that, you should do that. But here the technical condition is that you should have received, but don't forget that it should have been but for the business purpose. That will be one of the criteria. Okay. Further, for the purpose of this particular clause, it shall be deemed to have been that the registered person has already received the goods, where the goods are delivered by the supplier recipient to any other person upon the direction of the registered person. So in other words, if I am a registered person, if I say that I want to purchase something, I purchase it, but I say that you please deliver this particular goods to that particular job worker. Say for example, so actually under my instruction, under my direction, I am the actual purchaser. It has been supplied to someone else. So law has simply made very clear it is something called the bill to ship model. In this particular situation, it is as good as it is received by you, and you will be eligible for the purpose of input tax credit, subjected to the other conditions of this particular section. Okay. Further, subject to section 41, 43, etc., the tax which is charged in respect of this particular one has already been paid to the government. In other words, the invoice which I am taking it from my particular supplier, that means my purchase invoice, whatever the taxes which I am claiming, the other person should have already paid this particular taxes to the government. In other words, government is never going to give you the credit from its own pocket. Okay. Further, the goods against which the invoices have been received in lots or in installments. Supposing if you have received your goods into 3 installments, in that case you will be entitled to the credit only upon the receipt of the last installment. That means you will get the full credit only, but you will get the credit only when you have received the last installment. So in case of a larger chunk of deliveries, it is advisable for you to break up the invoices as per the delivery. For example, you have some big consignment to come, which is going to come, say for example, in 3 parts. It is better you break up the invoice also accordingly. So if you keep one big invoice and your deliveries come in installments, then you will take the credit only when the last installment has already come and not otherwise. This is one of the very good points for the purpose of consideration. Further, provided further the recipients fail to pay the supplier the goods or services, the money which is payable and tax payable on a reverse charge basis, the amount of the forward charge value supply along with the tax payable thereon, period of 180 days. Okay. Now understand, the recipient fails to pay. So for example, I am the purchaser. That means I am the recipient of the goods or services. Okay. So I am the recipient of the goods or services. Now I have to pay the money. Naturally, no, I have to pay the money. If I fail to pay the money within a period of 180 days, it is basically my creditors. If I have not paid my creditors beyond, if I have not paid the creditor within 180 days, this is how it is to be understood. That means my creditors are outstanding beyond 180 days, then I will not get the input tax credit. That means I should have also paid the money. In other words, outstanding creditors. This is how the accounting language which can be used. So if it is outstanding for greater than 180 days, I will not get the amount of the input tax credit. Okay. Now further, Provided also the recipient shall be entitled to avail the credit of input tax on the payment made by him towards the value of supply goods services along with the tax payable thereon. That means if I have paid my payment timely, I will be eligible for the purpose of input tax credit, that is timely. Okay. Further, if the registered person has claimed the depreciation, in other words, the input tax credit, for example, on the capital goods, if I am claiming depreciation under the provisions of the Income Tax Act, then the input tax credit is not available. In other words, I cannot take the credit under GST and the depreciation under the income. Both is not permissible. The corresponding provisions are also existing under the Income Tax Act, where Income Tax Act also makes it very clear that if this particular credit you are going to take it under the indirect tax laws, then they will not give you the depreciation. Now we have that corresponding matching, so you cannot take both. You take either credit or you take depreciation, as simple as that. Okay. Further, the registered person shall not be entitled to take the input tax credit in relation to your documentation beyond this particular upper time limit. In other words, this is your logical overall upper time limit in order to settle your input tax credit. So, for example, it may happen that you have taken the invoice but you have not claimed the credit, or maybe the invoice has come late, or maybe some things have gone whereby which you have forgotten to claim the credit or something like that. So this is your overall upper time limit. Okay, for the month of the September following the end of the financial year. So basically, if my credit is for a particular financial year, next year the month of September, okay, in which the invoice etc. relating to, or the debit credit note etc. pertaining to this relates, whichever is earlier. Okay, so if I want to claim the input tax credit, this is overall macro time limit. I repeat, this is overall macro time limit, that beyond this particular time, I cannot take this particular input tax credit. I repeat this. What is this particular overall macro time limit? Okay. Now, if I am claiming this input tax credit, I shall not be entitled to claim the input tax credit after the due date of furnishing of the return under section 39 for the month of September following the end of the financial year. That means my financial year will end in the month of March. After the March, the September will come. That September month, whatever is my due date for the purpose of filing of the return of the GST, that particular due date is one of my cutoff overall macro time limit in this particular situation. Okay, that is one time limit. Okay, to this particular thing, note pertains or furnishing of the relevant annual return. So my September month return due date or my annual return furnishing due date, whichever is earlier, this is my overall macro time limit. I repeat, overall macro time limit to claim the input tax credit. Now, for example, put it logically. For example, if I want to claim my input tax credit today, but that particular bill, invoice, etc. is, say, for example, 5 years old. So, for example, then I will tell the government, oh, I have forgotten to claim that particular input tax credit. Now you give me after 5 years. Government says, sorry, because this was your ultimate macro upper time limit, and beyond this particular time limit, your input tax credit will lapse. And that means it has to be foregone. It has to be foregone forever. Nobody can take that particular advantage of the input tax credit. Basically, your input tax credit beyond this particular time limit will become zero. Logical thing I am just telling you. And you will not be able to claim the input tax credit. Now, friends, provisions relating to the apportionment of the input tax credit. Friends, these particular provisions are again very simple, but there are some some specific computations which might be required to have been done. See, there are two situations. Broadly speaking, there are two situations. One, you are using the input tax credit in relation to business use also and non-business use also. That means basically it is something like a mixed use. Or maybe you are using the input tax credit in relation to the exempt supplies and also the taxable supplies. So ultimately, friends, under this particular clause, where any goods services which are partly That means partly for the purpose of business and partly for the other purposes. So partly for the business and partly for the other purposes. In that particular case, there is some specified rules which tells you that there will be some sort of a disallowance with respect to the input tax credit. But mind you, friends, in the GST regime, that disallowance is not like what we do it normally under the direct tax laws. Here there is a specific manner in which the computations which are to be required to be done. But in a simplistic language, it will be called as a disallowance. Further, this is clause 1 and this is clause. This is basically the two of the most valuable clauses should be kept in mind, where it is partly, that means goods services which are used by a registered person partly for something and partly for something else, affecting the taxable supplies, including the zero rated supplies under this particular clause. Okay, so it is partly for the taxable supplies, including the zero rated supplies, and under this particular clause, and partly for affecting the exempt supplies. So partly for taxable and the zero rated, and partly for exempt supplies. Now basically it is something like a mixed use. Mixed use means some portion is used for this purpose, some portion is used for this purpose. In that case, there has to be some disallowance, and there is a method which is provided by the law, and that method should be kept in mind. But before that, friends, one of the very important point that I want to bring it to your notice. However, in my regular class, friends, I have already explained to you method, computation, questions. So those basic things you should revise it by yourself. I will also do the best for the revision classes. But one of the very valuable point, friends, that you should not miss it. This is what I'm just trying to tell you. Okay. Now, in this particular case, it is trying to say that, listen very, very carefully. I'll take just a minute extra. Although it's a revision class, where the time is very precious. But see, here partly for taxable and zero rated. So taxable and zero rated are basically on one side. Okay. In other words, if their outputs are taxable, then to that extent, the input tax credit is permissible. That's the logic of the law. So if your output is a zero rated, that means your output is an export. Zero rated is basically export. So if your output is an export and input tax credit which are used for making exports, so they are in the eligible criteria. That means they are eligible for the purpose of input tax credit. In other words, the taxable output and the zero rated output are considered at par from this particular provision point of view. However, exempt supplies are on the other side. That means if there are input tax credit in relation to the exempt supplies, to that extent it is going to go for the disallowance. That means you are using inputs for the purpose of making exempted outputs. That is going to be basically the form of a disallowance of the input tax credit. So exempt supplies are not, that means input used for the exempted outputs are not eligible for input tax credit. Okay. However, in some proportionate way, if it is in the mixed one. But these exempt supplies are further defined here, further explained here, rather in form of an explanation, that the value of the exempted supply shall not include, keep this particular point in our very, very big memory, shall not include the value of activities or transaction specified in Schedule 3. Shall not include specified in Schedule 3. That means if there are any what should I say, the entries of the Schedule 3 that will not be included for this particular purpose, that should be kept, this particular explanation shall be kept in mind, except, okay, those specified in paragraph 5 of that particular schedule. Okay. In other words, in my regular class, friends, that I have already explained this particular thing into your particular mind very, very carefully. Okay. So exempted supply shall not include the value of the transaction specified in Schedule 3. Okay. That means those transactions which are into your negative list, that will not be considered as an exempt supply for the purpose of this particular calculation. That is basically your apportionment of the credit. However, except those specified in that paragraph 5. Okay. So keep this one particular point in your back memory very much, because here you have to take the ratio of exempted supply, taxable supply. So you have to allocate that, how much was exempt allocate. So your Schedule 3 items shall not be included in this particular exempted supply except for that particular paragraph 5 items. That is one of the very, very important point, because here any calculation, it can really be very nasty if the question goes into the much more greater there. Then this particular clause 3 also, Again, a very, very valuable clause. The value of exempted supply under this particular clause, that is a subclause number 2, okay, shall be calculated in such prescribed way, okay. So your exempted supply can be prescribed in this particular case and shall include, listen very, very carefully, it shall include the supplies on which the recipient is liable to pay tax on a reverse charge basis. It shall include where the recipient is liable to pay the tax on a reverse charge basis. Okay, so the exempt supply for this particular purpose is going to include your tax which you have to pay on a reverse charge basis, transaction in securities, sale of land, and subject to clause B of this particular paragraph 5 of schedule 2, that is basically your sale of building and the sale of building where the occupancy certificate is already received. In other words, the exempted supply will include, it shall include all these items on a reverse charge basis. In other words, input tax credits in relation to these outputs. Keep this in mind. Input tax credit in relation to these outputs, which will be taken as exempted supply. So input tax credit will not be available. Put it differently. For example, the tax that you are paying with respect to reverse charge basis, for those taxes, you are not eligible for input tax credit. One of the very, very important thing that you should not forget. Okay. So this is the meaning of your exempted supply under the, and this can also be a very good MCQ material, friends. So your clause 3 and the explanation. Okay. This is giving you the clarification with respect to the what is an exempted supply. Okay. Now further, there is a method which is provided in which that particular apportionment, etc., which is required to be done. Now, this particular method, technically, if you see that particular rule 42 is going to be a little bit bulky and little bit of, what should I say, some students find it a bit complicated, but it's a very simple rule, very, very simple rule. Understand the logic of this particular rule and any working for the apportionment is going to become very, very, very simple. Okay. Now, here what you have to do is, whatever is a total input tax credit, whatever is a total input tax credit, listen very carefully. This is as per the rule basically. If you go in the theoretical aspect of the rule, it's going to become very, very bulky. But I'm telling you the hardcore fundamental of this particular rule. If your total input tax credit is X amount, okay, from that, how much is exclusively, I repeat, exclusively for non-business purpose, how much for exclusively for exempted purpose, how much is exclusively in relation to the block credit. That means if you can identify that these inputs have already gone for the exempted output, if you can identify one-to-one identification, if you can identify that your inputs are exclusively used for a non-business purpose, that means you are 100% sure that this is for non-business. So whatever that you can allocate in the sense that what is not eligible, if you can 100% allocate, you have to allocate it. Okay, that's a theme of the law. Okay, however, if it is exclusively for the taxable supply, that means your inputs are directly used for the purpose of making outputs, and the outputs are taxable outputs. So if you can allocate, you have to allocate it. Okay, so if it is for taxable, whatever is the full amount, that will be allowed. Okay, whatever is for non-business or whatever is for the exempted purposes will 100% be not allowed. So out of X amount of your total input tax credit, you have to exclude, out of the total, you have to first of all exclude whatever is the exclusive use. Now, these exclusive use can be allowable exclusive use or non-allowable exclusive use. Okay, so that is what you have to exclude it. The balance of your input tax credit, I will, in simple English, I will call it as a mixed use. Okay, that means that is a situation where it is partly something and partly something. That means you are not able to fully identify that this balance exclusively for this particular purpose. So it is something like a mixed use or it is something like, you can say, common credit. Okay, now this common credit has to be disallowed in a certain specific manner. That means certain disallowance will take place out of this particular mixed credit. Okay, so once you have got this particular mixed credit, then the rules makes it very clear that if it is in relation to the exempted and taxable mixed kind of a situation, then you have to use the turnover criteria. Okay, so you have to use the turnover criteria, that how much was the total turnover and out of that how much was the exempted turnover. That exempted turnover, basically you are not eligible for the purpose of input tax credit. So to that extent, the proportionate figure, this is what I'm just trying to say. So this is one kind of a disallowance. Second kind of disallowance, that if it is a non-business use, then 5% of the mixed credit straight away 5% of the mixed credit will go for the disallowance. And mind well, here in the GST regime, disallowance in the sense that you might have already claimed in your input tax credit, so this much disallowed figure logically will be added to your output tax. That's a method of GST. So we don't just do that rough calculation of netting off in the government's ledger where this particular credit is appearing. So this much amount, which is basically to be disallowed, this is what I'm just trying to say, in the sense that it has to be added to the output tax liability of that particular person. Okay, further, this was one of the questions that we had already solved in our regular class, but I just bring it to your notice. Friends, in this particular question, you have all these mixed kind of use and kind of situation. And just look at the way the answer is to be solved, and it should be kept in mind. Okay, so just for the analysis, you should have the total credit. Okay, all this data will be printed in the question. So this is your X amount total credit. Now, out of this total credit, they call it T1, T2, T3, etc., etc. This is exclusive use. Keep this in mind. Exclusive use. The exclusive use basically means that you are able to identify that these inputs have exclusively gone for non-business use or a business use, as the case may be. That means there is a one-to-one nexus. You can just call it as something like your direct material. Now, for example, if you are manufacturing this particular pen, in this particular pen, friends, there are some material which are going as a direct material to this particular pen. This which what we will call it as a exclusive use. So you have to identify based on the available data. Okay, so exclusive things are to be identified. Thereafter, whatever that you are left with is called as a common credit. Okay, so common credit is this per figure. So what was this figure? From the total exclusive things you have already excluded, the balance is your common credit. Okay, from the common credit, friends, you will have to multiply the appropriate percentage or appropriate turnover criteria, whatever the data is available to you in the question. So this was the turnover criteria where there was exempted output also, and there was a taxable output. That means the exempted output divided by the total turnover. So this is the turnover ratio which will go for the business. Non-business use, you have to multiply the specific percentage, and you get, so this is total amount of disallowance. Okay, this total of amount of disallowance in the GST regime, it is not just that it has to be excluded from the income. It is not like that. It has to be added to the output tax. That means your input tax credit ledger will remain as it is intact, but this much liability will be increased. And to that extent, your output tax liability, that means your ledgers in the GST, is going to increase by this particular extent. This is a method in which these particular calculations, etc., which are required to be done and which are required to be carried out. Okay, here one of the point which I would like to once again repeat, and in fact I've already explained, but I think the students can really do a lot of mistakes on this particular front. It is exempted supply of the taxable supply. Okay, that was based on that clause 2, 3 explanation, etc., all those things. Okay, the exempted supply and the taxable supply. Remember one thing, the taxable supply always includes a zero rated supply, and this is a standard regime almost everywhere in the GST. In other words, the export incentive, this is what they are trying to say. That means inputs used for the purpose of making exports, those inputs are eligible for some refunds, eligible for some benefits. In other words, they want to give export promotion, and always India wants to give the export promotion. So your taxable output always includes your zero rated, basically your export for all calculation purposes. Okay, it is all for calculation purposes. And the exempt supply includes your transaction securities, land, sale, building, reverse charge transaction. In other words, these are all regarded as your exempt supplies for this particular purpose. In other words, on the exempt supplies, logically you are not able to get the input tax credit. In other words, you do not get input. This is what I have already noted here. For the exempt outputs, that means inputs used for the exempted outputs, you are not eligible for the input tax credit. But if you have used inputs for the purpose of making a taxable output, you are eligible for the purpose of input tax credit. And this is one of the key major difference between your input and the outputs. Okay. Further, section 17, subclause 4. There is a special scheme which has been incorporated by the law in relation to the banking financial institution. Understand this very, very simple scheme, very, very simple scheme. But remember one thing, what is the purpose of this particular scheme? The purpose is that if you see this particular meaning of the exempted supply, that is exempted basically output, it includes, the exempted includes the transaction of securities, Okay, now the banks, financial institutions will have lot of transactions, because for them securities is like your daily blood. That means it's like their life blood. They're dealing into their securities is very very much common to the banks, financial institutions, and so they are always going to have a lot of complications in their practical GST implication, that they have to use the turnover criteria, they have to do those particular calculations of that T1, T2, T3 and all that kind of situation. So for them, and because considering this, for them there is a special scheme which is already special, rather I should say a special adjustment for this particular people, and it says that the banking financial institution, okay, including a non-banking financial company engaged in this particular business and all that kind of things, they can get the amount equal to the 50% of the eligible input tax credit. Okay, they can get they can take the amount equal to 50%. This is 50%, okay, of the eligible input tax credit, or on the capital goods as the case may be, and the rest shall lapse. That means rather than doing that T1, T2 and all that calculations with respect to the bank financial institution, the law has given them an option. That if you want, just take 50% and forget everything. Okay, so this particular option is possible for the bank's financial institution under 17 subclause 4. Okay, under this particular 17 subclause 4, friends, this is the way in which we can do that simple calculation. This was one of the questions that we have already solved in our regular class. Now you have a common credit, okay. Now if you want the option of section 17(4), where it is 50% you take, 50% you forget it. Okay, so just do 50% if you are doing this particular optional calculation. Okay, and if you are not doing that optional calculation, you have to do that T1, T2, T3 and disallowance and all that kind of things, and you have to multiply with that particular ratio, and that much will be added to your output tax, and the balance will be your eligible credit. So if you want, you can do it optionally. This is what the law is trying to say. You can do it optionally, and this is a simplified thing which is provided by the law, and a very good thing, because otherwise for some that small difference here and there, now this bank's financial institution has to do a lot of administrative work in terms of the GST. So it is a very very friendly and a good scheme with respect to the bank's financial institutions. Now friends, section 17(5), the block credits. Friends, this particular block credits under section 17(5) has undergone a big change. I repeat, it has undergone a very very big change by GST Amendment Bill 2018. From this particular, or with effect with this particular bill, this section 17(5) has undergone a very good change, and I would definitely expect that in near future, these type questions do come in the examination condition. So first of all, section 17(5), now the new provision only I am straight away explaining that to you, and that is, see, under section 17(5), input tax credit shall not be available in respect of the following situation. So this is what we call it as a block credit situation. And clause A, clause AA, clause AB, these are newly inserted provisions. I repeat, they are newly inserted or they are newly amended provision. This clause B is also newly amended provision. So basically what I'm just trying to tell you is AA, AB and B. These are the newly amended provisions, and then clause C and onwards, that is all these clauses, these are basically C, D, A, E and F, on all those clauses, they are pretty the older ones only, but let us quickly revise that. Now friends, it says that in the following situation you are not eligible. I repeat, you are not eligible for the purpose of input tax credit. Now the motor vehicles, so motor vehicles for the transportation of the persons, okay, having approved seating capacity not more than 13%, not more than 13 persons, okay, including driver, they are used for the following taxable supplies as an exception. Okay, so that will study. The first of all, the motor vehicles are not eligible for the input tax credit. Now first of all, it is for the transportation of the persons only. So basically, if there is any vehicles for the transportation of goods, that means you call it as a trucks. Okay, if you say trucks, tempos, which are basically for the transportation of the goods and they are not for the transportation of the passengers, on that you are definitely going to get an input tax credit. Okay, so if it is only for the transportation of persons, I repeat, if it is only for the transportation of the persons, okay, then you are not eligible for the purpose of input tax credit. Further, approved seating capacity, now it is specifically provided approved seating capacity of not more than 13%. That means it should be less than equal to 13 persons. Okay, so that is also including driver. So basically most of your SUVs and all that will come in this particular category. Okay, so if you say that our passenger SUVs, like for example Fortuner, or like for example you can say Tata some SUV, Mahindra SUVs and all those are there, so all those vehicles will come in this particular category. You are not going to get input tax credit. Okay, so passenger vehicles are not going to get it. However, there are some exception is very simple. Okay, where there is any further supply of the same to same motor vehicle, that means for example if there is a Maruti is supplying it to the dealer, supplying it to the customers, so transaction between Maruti to dealers, okay, this particular transaction will be subjected to your GST. And when the dealers are going to have this particular input tax, and the dealer going to supply it to the customers, the dealers will get the input tax credit also. The reason being that this dealer is doing a further supply of this particular motor vehicles. So any taxpayer who is doing further supply of the motor vehicle will be eligible. If there is any transportation of the passenger, you will be eligible for the purpose of input tax credit, because it is covered by the exception category here. Okay. Further, imparting any training on driving or such motor vehicle, basically your driving school, motor training schools. Okay. So for those people, you will be eligible for the purpose of input tax credit. So interpretation here is pretty simple. Normally, you will not get input tax credit. In following is the exceptional situations. That means in these situations, you will get the input tax credit. Okay. So this is with respect to the motor vehicle. Now with respect to the vessels and the aircraft. Okay. You are not going to get the input tax credit except when this particular situation is already coming into situation. Now here also these exceptions are almost pretty similar, so I'm not spending a lot of time in the revision classes. So vessels and aircrafts are also not eligible, subjected to the exception. Now this AB clause is pretty more important, which says that services of general insurance, servicing, repair is very important, and maintenance, repairs and maintenance. So this particular situation under clause AB is with respect to your input tax on repairs, maintenance, servicing or general insurance of these particular cars, motor vehicles, vessels or aircraft, as referred to in clause A, clause AA, as the case may be. Okay, so on these items also you are not going to be eligible for the purpose of input tax credit. However, there is an exception. An exception is pretty simple and it's going to be of a similar type, provided that the input tax credit in respect of services shall be available. It shall be available where these conditions are satisfied. So basically it is trying to say that normally repair, servicing, maintenance, general insurance, normally they are not eligible for the purpose of input tax credit. However, there is an exception, and the exception is that where these repair, maintenance, general insurance, servicing, etc. Okay, it is in relation to the clause A or clause AA, which are used for such purposes. So logically you should say, and you should logically understand like that. Okay, that if there is any vehicle, vessels, motor vehicle, vessels, aircrafts in the above clause, that is A or AA, if they are covered by the exceptions, that means if they are eligible for the input tax credit, even the general insurance, repair, servicing, etc. will be eligible. And if they are not eligible for it, if the vehicle itself is not eligible for input tax credit, then repairs of that particular vehicle also will not be eligible for the purpose of input tax credit. So whatever will be the treatment of the vehicle will be the same treatment for servicing, repair, maintenance and the general insurance. Okay. However, there is one more extra clarification. It says that where any such services are received by a taxable person who is in the manufacture of such motor vehicle, then you are eligible for the purpose of input tax credit. So here the interpretation, don't forget and don't confuse yourself. It says that in the following situation, see in the following, provided that input tax credit
services shall be available in the following situation. So if you are a manufacturer of the motor vehicle, then you are naturally going to be eligible for the purpose of input tax credit. Further, if you have got these particular services with respect to the supply of general insurance services in respect of such motor vehicle vessels, etc. So if you have got this particular insurance which is in the supply of the general insurance services, so basically you are basically probably supplying the general insurance and you have got this particular general insurance. In that particular situation, you will be eligible for the input tax credit. Okay. Further, this clause B is also been amended, of course, by the GST Amendment Bill 2018, and it also further makes it very clear that, see, food, beverages, outdoor catering, beauty treatment, health services, cosmetic, plastic surgery, leasing, renting or hiring of motor vehicle, vessels, aircraft, etc. referred to in this particular clause, life insurance, health insurance. All these items you are not eligible for. I repeat, you are not eligible for the input tax credit. Okay. Further, provided that the input tax credit in respect of such goods or services both shall be available, okay, where the inward supply of goods or services or both is used by the registered person for making the outward supply of the same category. So basically, if you are making a resupply of all these items in the same to same category of goods and services or both, or as an element of the taxable or composite or mixed supply. So if these your inputs are as an element of composite or mixed supply, then also you are eligible for the, basically for example, see, like a subcontracting, I mean logically you can say. So such situations will be covered by input tax credit. Any membership to the health club, fitness center, travel benefit extended to the employees, etc., we are not eligible for the purpose of input tax credit. And the exception will be that if it is obligatory by the employer to provide the same under some law for the time being in force. So if it is under some law that it is obligatory for you to provide these particular benefits, then you will be eligible for the input tax credit. Otherwise, input tax credit is not permissible on this particular situation. Now, clause C and clause D together I will take it, and again you mark it as pretty important. The work contract services for an immovable property other than plant and machinery. So basically, plant and machinery erection is eligible for input tax credit. Basically, it's a part of the industrialization. So if there is any immobile property, any work contract for immobile property, you are not eligible for input tax credit. However, if it is a plant and machinery, then you are eligible for the purpose of input tax credit. Okay, except where it is an input services for the further supply of the work contract services. So basically, if it is a subcontracting type situation, then input tax credit is available. But normally, any work contract for construction of an immobile property, you are not going to be eligible for the purpose of input tax credit. Okay, so remember this clause very, very importantly. Clause D is in fact even more important. Goods or services or both received by taxable person for construction of immovable property other than plant and machinery on his own account. Now these on account, now we have some couple of judgments also on GST in this particular front, I will tell you. Okay, so where there is any construction of immovable property on his own account, you are not eligible for input tax credit, and this is also including when such goods, services or both are used in the course of the furtherance of the business. So even if it is for the furtherance of the business, still you are not going to get the input tax credit. Now the point here is, what do you mean by your own account? The courts have interpreted that on own accounts basically means for the purpose of your own use. This is a very logical interpretation I'm telling you. Don't write these things in the examination condition. It is for the purpose of your own use. So just imagine something like that. Okay, supposing your balance sheet. Okay, now if you have any construction of an immobile property, so you are constructing an immobile property. Okay, say for example your cost is 105. Okay, now if you have any goods or services which are for the construction of an immobile property, so whatever tax that you pay on this, you are not going to get any input tax, because this property you are going to use it for your own purposes. This is on your own account. Okay, so you are not going to get the input tax credit. Further, even if it is used in the course of the furtherance of the business, that means even if it is your business premises. So, for example, construction of a building, but it is your corporate complex. So basically it is definitely for the business purpose, but still you are not going to get, I repeat, you are not going to get any input tax credit on this particular front. Okay, so construction of the property, you are not eligible for the purpose of input tax credit. However, had it been a plant and machinery, then naturally a plant and machinery is eligible for the input tax credit. Okay, so plant and machinery is anyway the exception on this particular front. Okay, further, the construction for this particular purpose includes reconstruction, renovation, addition, alteration, repairs to the extent of the capitalization. Repairs to the extent of the capitalization of the said immovable property. Now here the view which is taken, I repeat, the view which is taken very importantly and very precisely. Now, if there is any repairs to the extent of the capitalization, okay, in other words, if it is a capital repairs, if it is a capital repairs, it's basically improvement to that particular asset. Okay, then on that the input tax credit you are not going to get it. You are not going to get the input tax credit with respect to the capital repair, because to the extent of capitalization, so logically if there is any value additions to your premises or property, then you are not eligible for input tax credit. However, if it is a plain repairs, that means your revenue repairs, some maintenance kind of situation, then on that whatever cost that you have, you will be eligible for input tax credit. I repeat, if it is a plain repair, that means simple maintenance of the property, okay, will be eligible for the purpose of input tax credit, but maintenance in form of the repairs. Okay, so if it is not capitalized repair, in our simple accounting language we call it as a revenue expenditure, then in that situation you will be eligible for the input tax credit. Okay, very important interpretation. Keep it in your back memory and always. Okay, now the further parts of the block credits. Okay, now point number E, goods, services or both on which tax is paid under composition. In fact, the composition person cannot even issue an invoice. So without an issue of invoice, you cannot take the input tax credit also. So it is a very natural thing that any goods, service both for which the supplier has paid tax under section 10 because of a composition scheme. So on that particular money, there is no invoice basically, and therefore you cannot get an input tax credit for those inputs which are coming from your composition supplier. Okay, next, goods, services of both received by a non-resident taxable person, except on goods imported by him. So non-resident taxable person is not eligible for any input tax credit except on the goods imported. So if it is imported by him, on that he will get the input tax credit. Okay, because GST at the time of import, if you are paying, you will get a credit for that. But any other things, the non-resident taxable person is not, I repeat, is not eligible for the purpose of input tax credit. Any goods, services for personal consumption, mamma mia. Further, any goods lost, stolen, destroyed, written off, disposed of, by way of gift or free samples is not eligible for input tax credit. Very simple clause, but very important clause. Basically, the logic of this particular point is that anything which is lost, stolen, destroyed, etc., ultimately it is not used for the business purpose because it is stolen. No, and that is the reason you are not going to get any input tax credit on this particular front. The next one, the tax paid in accordance with the provisions of 74, 129, 130, it is basically some demand recovery and kind of situations. So any such taxes paid on these particular fronts, you are not going to get any input tax credit for any taxes paid which is on under this particular section. Basically the demand recovery in some special situations type of cases, you are not going to get the input tax credit. Further, the credits in special circumstances. Now this is another concept which is under section 18, which is already provided.
where in certain situations there is a credit in special circumstances. Let me give you one simple example, and each and every example is on the same to same grounds. The concept of the law is, listen very carefully, the concept of the law is input and output. Okay, if the output is, say for example, taxable, I repeat, if the output is, say for example, taxable, then inputs which are used for the purpose of taxable outputs are of course eligible for the purpose of input tax credit. In other words, if your output is exempt, if your output is exempt, and if you are using any inputs for those exempted outputs, you will not be eligible for input tax credit. There is a simple logic of the law. So if the output is taxable, the input credit you will be eligible. In general, I'm just telling you. But if the output is per se not taxable, that means if by itself per se is exempt, then inputs which are used for making the exempted outputs are not eligible for the purpose of input tax credit. Now, this particular kind of basic concept, read with the other things, can make a little bit of a extra adjustments under these particular provisions. Now understand one thing very carefully. I'll just take up one particular example. Okay. Now under this particular clause, before, that means there is a transition always, because before and after kind of situation, somebody who was not liable to register, and now that particular person is going to get registered. Okay. So earlier you are not registered. That means when you earlier you were not registered, that means you are not taxable. I mean, you have to just imagine like that. So earlier when you are not registered, so maybe you will say that you are not taxable. But now when you are already registered, you will become taxable. Okay. So there is a transition. There is a transition. The transition which has taken place from a cutoff date, and that particular cutoff date is that before you were not registered to GST, and after that particular cutoff date, you are liable to the GST. Now, when particular transaction has already taken place, I'll just take a cutoff date, and everywhere this is a cutoff date. These are all examples of a cutoff date. This is your cutoff date. Okay, so before and after. Okay, now before, when you are not registered, just imagine logically you are not taxable, and after that you already registered. That means now you are taxable. Okay, now it may so happen that when your business was already going on the cutoff date, there can be inventories. Inventories. Logically, you can call it as opening closing stocks. Okay, so now when you are becoming taxable to GST, listen very carefully. When you are becoming taxable to GST, you are going to be having some inventory on that particular cutoff date. Now those inventories, logically you can say the stock on the cutoff date. Okay, those inventories were previously in the non-taxable category. Logically, I'm just telling you, and after the cutoff date will become in the taxable category. So those inventories before were never eligible for an input tax credit because you were not registered person only. But moment you register, thereafter those inventories will become eligible for the input tax credit. So this transition, what the lawmaker have thought, and it is a very good thinking, that lawmakers have thought that on these inventories you will get the input tax credit which is on the cutoff date of your effective date of registration. So there has to be a cutoff date on that. Then that cutoff date can be any cutoff date, any date during the day, depending upon the situation. So on that particular cutoff date, whatever are the inventories that you have on the inventory, you will get the input tax credit. Okay. Now, had it been the opposite situation, let's say for example, previously you were registered to the GST, and now you are getting deregistered to that particular GST. Okay, so exactly opposite thinking that you have to do. That if previously you were already taxable, that means you are taking input tax credit. Now you are deregistering yourself, so then you will not get the input tax credit. So whatever inventories at that particular point in time, whatever credit which you might have taken has to be reversed. Okay, so it is like in a circumstances, either you will take the credit on the inventories logically, or you will have to reverse the effect of that input tax credit if there is a equal and opposite transaction. Okay, now I will just focus on one particular transaction. All the transactions effect is almost the same in this particular circumstances. Okay, now let's say this way. Now previously you were in the composition scheme, then there is a cutoff date, and after a cutoff date you become a normal taxpayer. Okay, now when you are in the composition scheme, you are never going to get any input tax credit because that was a specific provision of the composition. So before the cutoff date, you are not to get any input tax credit, and once you come in the normal regime, normal GST regime, you are eligible input tax credit. That's the logic of the law. Otherwise, you have to remember and mug up a lot of things here. Now, on the cutoff date, you will have the opening closing stock. That means there will be some inventories. So moment you become liable and moment you register to the normal GST regime, on that cutoff date you are going to have the inventories. So what is the loss is that now after the cutoff date you are eligible for the input tax credit. So the inventories which will be used for that taxable outputs will be subjected to the input tax credit. So now on this particular cutoff date, whatever are the inventories, okay, those inventories, okay, now one more thing which I want to bring it to your notice, that these inventories, don't confuse that always you will get the input tax. That means all other conditions of the input tax credit has to be set. Like for example, it has to be accounted, the payment should have been made, you should have the proper tax invoices. So all the basic conditions with respect to those inventories should have been satisfied. That is one of the point. Second thing is that these are all situations of the special credits, and for that reason there is a general purpose overall time limit. That means if your inventories were older than 1 year, then again you will not be eligible for the purpose of this particular special adjustment. I call it as a credit in special circumstances. You will not be eligible. Now how do you solve these particular questions on this particular front? Okay, now this was one of the questions, a very simple question that we had already solved. Okay, now in this particular situation, friends, now you are eligible for the input tax credit. Okay, so previously you were in the composition scheme, example, because this question is like that. Now you are coming in the regular category. So now when you are coming from composition to the regular category, that means now in the regular category, that means after the cutoff date, you are going to become taxable in the normal regime. So what you will do, whatever are the inventories on the cutoff date, on that whatever are the taxes, that particular element you will be eligible for the purpose of input tax credit, subject to all the basic conditions of the input tax credit should have been of course satisfied. So question has given you data. This data I have already translated, that this is your inventories, stock, finished goods, capital goods, etc. In this particular situation, you take the total, this much credit you will get it after your registration date. That means when you will come in the normal tax regime, this much will be the input tax credit which will be eligible for you, because previously composition was not eligible, but now in the normal tax regime you are eligible. This is how the adjustment, logically I call it as the inventory adjustments, which is to be carried out on a cutoff date. Okay, next, manner of utilizing the input tax credit. Section 49. Section 49, friends, makes it very clear that this is a specific manner in which the input tax credit has to be adjusted or it has to be considered. Okay. Now here there is a simple mechanism that should always be kept in mind. Now, there are something called as the priorities, and the priorities is basically like this. See, you have input tax. Beginning starts from the input tax credit. Remember always. Now you have IGST, CGST, SGST, or UT GST. State GST and UT GST is always at the par. So I'll not use state and UT. I'll just say state GST. So first you have to consider this. So you have to do all the complete adjustment with respect to IGST first. Okay. So your flow of manner of utilizing of the input tax credit is, first you have to do only IGST adjustment. Remember, this flow pattern should be understood and kept always very clearly, because sometimes this can confuse you in the examination condition. So first you have to do IGST. Okay. So input tax credit of IGST, first you have to adjust it against the IGST fully. Remember all this. So your thinking process should be like that. I'm not going into the technical details of this particular provision. This is what it is just trying to tell you. The first you have to give preference to the IGST adjustments only. So IGST against IGST, that way you have to adjust. Okay. Then whatever is the CGST is a second adjustment. You have to adjust it against the CGST. So first you have to exhaust whatever is the balance for IGST against IGST. Then you have to just wait for a while. Then second you have to adjust CGST against CGST. I mean, then you have to wait for a while. Okay. Then the state against the state. Okay. So this is first preference. I repeat, the first preference. First you have to do IGST to IGST, CGST to CGST liability, and SGST to SGST liability. Okay. This is what you have to complete it. Now, if there is a still unutilized balance, so IGST, you have to always go in the top priority first. Okay. So IGST, still there is an unutilized balance. Okay. This particular figure, IGST you have to utilize first against IGST only. Okay. And if you cannot utilize, then you can utilize it against first the CGST. Okay, so thereafter the next top priority is CGST and the top priority is SGST. So then if there is unutilized balance of IGST, first you have to do it against CGST, then later on you have to do it against SGST. So you have to complete this first. This is the manner of utilization. So you have to fully complete your transfer of credit from IGST ledger to the other ledgers, if any. Once it is fully exhausted, this is one of the main message which I want to give to you. Once it is fully exhausted, then only go to the next step. Okay. Once this is completely done, that means you are in a position that, okay, I already transferred the full credit from IGST first to CGST and then the SGST. Now I am already done. Now there is no other scope. Then I'll have to go to the CGST. Okay. The CGST can be first utilized, and I have already utilized against CGST first of all, and still if there is an excess, so thereafter I can transfer it to IGST. So between the center and the state adjustment, the center adjustment is the first. This is what I want to tell you. Okay. So now once you have done this particular basics, now your CGST will be adjusted first, and only after, once you are feeling that, okay, now I cannot do any further adjustment, then go to the and adjust it against state. If the still you have unutilized balance, you can transfer it to the IGST. And sometimes these particular things can complicate. In other words, some people may jump, and the law does not going to allow you to jump. That means IGST, supposing if you directly want to transfer to state GST, that way it will not be possible. So the law is now very specific. Law says, I once again repeat this manner of utilization. Okay. So among the input tax credit, always first adjustment is IGST, second is CGST, third is SGST. This is your internal priority with respect to the thinking. Okay. So you have to complete IGST first. Okay. Against this. This is your first step. Is that absolutely clear? So actually at this level you can go for the transfer, but better not go. Reason being that it could be a mistake. It can give you a mistake. Okay. So I'm just telling you that this is your first IGST against IGST. Then you have to do this. This is your second. Then you have to do this. This is your third. Okay. Once you are done this, then your next thing is still there is unutilized balance. Then go to this. That is the second utilization. In that also there is a priority that first do only IGST and do only CGST, and only last only you have to do SGST. And this preference you have to strictly follow for the purpose of manner of utilization of the input tax credit. One of the question, friends, that was already solved on this particular front. This could be a good question even in the examination condition. See, you have a GST liability, you have an input tax credit, you have opening balance, and you have a credit with respect to that particular month. Okay. Now this is your net figure. So this is a net figure which has to be developed first. So what is that I have done? I have done IGST against IGST, CGST against CGST, SGST against SGST. Okay. Now I have want to transfer the credit. Now in case of transfer of credit also, always first preference is to IGST. So I have to first transfer, if at all there is a balance, first I have to transfer only IGST. So this is what will be the first transfer. Okay. And even when I am transferring, first I have to give preference to CGST, and thereafter if any to the SGST. So I had extra credit with respect to IGST. So it will go first towards the CGST. It will go first here. Okay. The second it will go here. If at all there is further transfer of the credit, if at all that is required. Okay. So this is the manner in which the transfer has to take place. So only if I exhaust this particular transfer of credit, only thereafter I can transfer the credit of CGST, if any. Now in the given case, so in the CGST there is no extra credit, so just forget it. So first I have to do this, the transfer of this particular sum, and thereafter actually the question solves here, because at this particular stage I'll just have to make the net payment of cash, and that payment I have to make it to the government. But say for example, if there was a second level adjustment which I had to do, say for example, so first I have done this much of works, this is a completed work, then this is your next. Now supposing if this is already exhausted, supposing, okay, in that case the next preference I have to do CGST only. Then I have to exhaust CGST transfer, if any. If it was supposing there, in the given question it is not there, only then I have to go to the SGST. This is a strict manner of utilization of the input tax credit, which is to be carried out for the purpose of your tax liability, net tax liability calculations.